Aloha PTC. Thank you all for joining us this afternoon. I certainly wish I was there in person with you in Honolulu, but happy to be joining you all virtually. This next portion of our workshop will focus on price trends for wholesale bandwidth and IP transit services, and we thought it would be interesting this year to take a look at some of the most common pricing questions we've gotten over the past year and think through how they might play out in 2022. So today we'll be taking a look at, are prices increasing? Where are we now and how did we get here? How do trends compare across regions? The impact of transport on transit pricing? What does it take to be a new hub? Specifically looking at it through the lens of pricing and the impact of new supply and network investments on existing hubs and secondary markets. And finally, how might 400G pricing evolve? Trying to glean some lessons from the rollout of a 100G service and how things might be similar with 400G. So starting first with, are prices increasing? The two most predictable trends in the bandwidth market have been persistent demand growth and price erosion. And in previous iterations of this workshop, the question would not be if prices were declining, but by how much. But due to delays in new planned systems and upgrades, 2021 was the year we were asked, are prices actually increasing? Let's take a closer look. This figure yields pretty familiar results. Bandwidth prices on primary global routes continue to fall, as they always have. This figure highlights the weighted median 100G monthly lease price on key global routes over the past 3 years. As you can see, that pace of price erosion varies across geographies and over time, but overall, prices decreased an average of about 17% compounded annually across these key routes. Certainly, there is that range. You can see the bigger dips in Miami, Sao Paulo, that dark blue line, London, Singapore, and the turquoise. And while some of the trend lines might look a little flat on the other routes in between, prices are still steadily eroding. Prices decreased about 11% on London, New York, and 12% on Los Angeles, Tokyo over the past 3 years. And as I just mentioned, while prices continue to decline, that pace of price erosion varies by geography, and it was notably slower than previous years on a number of the key routes that we track. This is both a reflection of different levels of market maturity, geopolitical challenges, as well as supply chain issues. This figure highlights the CAGR price decline over the past 3 years for 100G wavelengths. As you can see, on routes with ample supply, price erosion has been consistent with historical trends. For example, that Miami-Sao Paulo route at the bottom of this figure. It's still feeling the effects of new cables and upgrades to existing systems after years of scant competition, and still exhibiting pretty robust price erosion. On the other end of the spectrum, routes with limited supply, like the LA-Tokyo and Hong Kong-Singapore routes that I've highlighted here, price erosion has moderated. And while we haven't included it here, we've noticed a similar trend on Johannesburg-London at the 10G level. There again, delays in upgrades on systems such as WAX have led to a little bit more moderate price erosion than we've seen in previous survey cycles. This slide takes a deeper dive into two regions that have especially felt the impact of supply constraints and examines trends within Asia and across the Pacific. In this chart, I've highlighted the CAGR price decline over the past 2 years in that dark blue column, so really our COVID time period, versus price erosion over the past 5 years for 100G services. And between 2019 and 2021, the average price decline across all the routes here was just 6%. And that's compared to an average of 20% over the past 5 years. So a pretty dramatic slowdown across a lot of these routes. And that lower rate of price erosion has really helped maintain a premium for routes within and across regions. This figure highlights 100G wavelength prices at the end of 2021, and as you can see, routes connecting the US to Hong Kong and Singapore, all the way to the right of this figure, maintain a premium over that core LA-Tokyo route. Hong Kong, LA still is about 1.7 times the price of LA-Tokyo, LA-Singapore at about 1.9 times the price of LA-Tokyo. And those lower rates of price erosion aren't helping erode that premium at all. Similarly, LA-Tokyo is still about a little over twice the price of London, New York, all the way to the left of this figure, which is where it's been over the past few years. And those price differences don't just persist across routes, but between providers on individual routes as well. Despite being competitive markets, we still do see carriers report a range of pricing on the LA-Tokyo route. This figure highlights the range of reported pricing over the past 3 years in the blue on LA-Tokyo for 100 gigabit wavelengths, and that red line represents the weighted median price. In 2021, our high price was still about a little over twice the low. That certainly is down from 2.9 times the price in 2018, but still a pretty large range in the market being reported. So what contributes to this range? Well, what you pay is often a reflection of how you buy. High volume customers often get lower prices. Customers opting for multi-year lease will often receive discounts as well and would likely fall in the lower end of this range. Low latency cables command a premium and would fall in the higher end. And customer type. Content providers, customers purchasing capacity to meet internal demand often receive lower prices than carriers who may in turn resell capacity in the wholesale market. And in the current climate, while we can say that we haven't seen prices necessarily increase, we have heard of some sales being on the higher end of the range than normal due to limited supply and less pressure to discount to win customer business. Switching gears slightly to see how these trends in the transport market have impacted transit pricing around the world. Transit prices reflect proximity to interconnection points and the cost of transport to reach them. And as bandwidth prices have fallen, transit prices have followed closely behind. This figure highlights the CAGR price decline for 10 gig IP transit port prices in key global cities over the past 3 years. And port prices have averaged about a 17% CAGR price decline globally since 2018. Very similar to the trends we saw a few slides ago in the bandwidth market. Similarly, the highest rates of price erosion have been in markets such as Sao Paulo and Sydney at the bottom of this figure, two cities which have seen pretty large declines in transport prices over the past few years. Similarly, lower rates of price erosion in Johannesburg, Singapore, and Tokyo, which fall towards the middle of the pack, those markets where we've noted more moderate price erosion in the bandwidth market. So are prices increasing? Long story short, while the recent pace of price erosion has slowed compared to previous years, we have not seen any increases in price. On routes with ample supply, that price erosion rate has been consistent with historical trends. On routes with limited supply, due to delays in new submarine cable systems and upgrades stemming from supply chain issues, that price erosion has certainly moderated, and this has helped to maintain price differences between routes and providers on individual routes. Going into 2022, delays in planned network projects will likely keep price points fairly stable in the short term, but once those new systems are launched and supply chain issues resolved to allow for those upgrades to happen, an increase in the pace of price erosion is likely. So moving on to our second question, what does it take to become a new hub? Now, this is a question my colleagues have tackled at numerous PTC workshops, but given a lot of the recent delays in supply, permitting issues, security considerations, network investors continue to look for alternative landing points and diversity in their networks. So it is an important topic to look at, particularly at how prices and trends in these potential hubs compare to existing regional hubs. And for this, we're going to look specifically within Asia. This is just briefly a list of the characteristics of regional hubs. So first, robust network connectivity in terms of submarine cables, data centers, internet exchanges, an open market with numerous service providers, cloud regions, and affordable bandwidth is key. First, looking at demand in some of these markets. As you can see, the amount of used bandwidth between 2016 and 2020 connected to Singapore, China, which includes Hong Kong here, and Japan, the region's existing hubs, continues to dwarf all other Asian countries, including some of those potential hubs such as Taiwan, Indonesia, and Philippines at the bottom of this figure. And growth rates in these countries continue to be high, all above 50% compounded annually between 2016 and 2020. Across all the markets featured here, the average CAGR for used bandwidth was about 55%. The fastest growing countries, though, are some of those non-hubs, such as Indonesia, Philippines, and Vietnam. So perhaps narrowing that gap a little bit with those higher growth rates, but still a pretty big gap in terms of used bandwidth. And given these growth rates and the capacity constraints on existing systems, it's unsurprising that operators are investing in new cables. In fact, the Trans-Pacific and Intra-Asian routes are projected to have the most new cable investment in the coming 3 years, with a combined investment of $3.2 billion. And this figure here highlights existing and planned cables at the end of 2021. And the biggest takeaway really is that a lot of these new systems will not only hit existing hubs within the region, but also some of these diverse markets such as Taiwan, Indonesia, and the Philippines, furthering the robust connectivity needed to become regional hubs. And finally, as John touches on in his presentation, cloud service providers are continuing to expand their network reach within Asia, moving those content and applications closer to end users. This figure highlights cloud regions for major CSPs in 2017 on the left, and those existing and planned today on the right. And the biggest takeaway is that not only are they expanding within existing hubs, but touching new regions such as India, Malaysia, Philippines, Singapore, and Taiwan. So what do prices and trends look like in existing hubs versus potential hubs, since affordable bandwidth is key? And this is the pricing portion of our workshop, after all. Well, the cost of connectivity to these secondary markets remains expensive. This figure highlights the weighted median 10 gigi IP transit prices in those dark blue columns and CAGR price declines in the red dots for the past 3 years. As you can see, a wide range in IP transit pricing still reported within Asia. Looking all the way to the right of this figure, you can see that markets such as Manila and Jakarta still remaining expensive. Jakarta about 9.6 times the price of Singapore. Similarly, Manila about 7.5 times the price of Singapore at the end of 2021. And what is causing these higher prices in these markets? Well, higher prices can be a reflection of a more limited number of providers, different regulatory environments, and higher underlying operating costs. And in most of these secondary markets, the underlying cost of subsea capacity to access internet hubs such as Singapore or the US really drives connectivity costs. And it often results in higher transit prices for end users. One kind of notable exception to this is Taipei, which has also been debated as a potential new regional hub. It's notably more comparable in terms of price to Hong Kong and Singapore. You can see it here on the left side of this figure, and it has seen the most significant declines over the past 3 years. But overall, connectivity remaining pretty expensive in these secondary markets. But that may be changing. Carriers are expanding POPs to offer service in these markets, and the underlying transport costs between these markets and Singapore continue to fall, making them more competitive. This figure here is highlighting weighted median 10G wavelength prices and CAGR price decline over the past 3 years on a number of intra-Asian routes. As you can see here, the trends compared to transit in the last slides are a little bit different. While there still is a wide range in pricing reported and connections to secondary markets are more expensive, they're experiencing a little bit higher rate of price erosion, the result of some of this new network investment. Over the past 3 years, 10G prices on routes to non-hubs have decreased an average of about 23%, and that's compared to an average of 16% on routes between hubs since 2018. So this should compress some of those price differences and eventually trickle down to the transit market, bringing some of those higher IP prices a little bit closer to our established regional hubs. So what does it take to be a new hub? Well, it's going to take a lot more than a few new submarine cable landings for countries to emerge as regional hubs. Other factors such as government regulations, market openness, costs, and geopolitical relationships also played a huge part in determining the extent to which international operators can enter a country. Affordable bandwidth and connectivity is also key. The Philippines and Indonesia are known to have strict government regulations and relatively high prices, whereas Taiwan is competitive from a pricing perspective, but the country's geopolitical relationship with mainland China remains unclear. A number of these markets are starting to show the characteristics of new hubs, but have a ways to go to be on par with existing hubs. But providers will continue to invest in them to offer diversity and see new market potential going forward. And that should eventually put increased price pressure on these markets, bringing them more in line with other markets within Asia. And finally, carriers are moving on to 400 gigabit transport links. And we've begun to think through, what will 400G pricing look like? And what lessons can be gleaned from the evolution of 100G pricing? And that's going to be the last question we answer today. As with previous step changes in capacity, 400G is being initially focused on shorter terrestrial links in Europe and the US, eventually moving on to transoceanic links starting with the Atlantic. And as we saw when 100G rolled out, price points and multiples vary by route, often corresponding with these regional price differences. This figure maps out weighted median 10 and 100G wavelength prices at the end of 2021 in those columns, and the price multiple between the two services in those red dots. As you can see, that between 10 and 100G, those shorter inter-regional terrestrial links such as Frankfurt, London, and Los Angeles, New York, all the way to the left of this figure, exhibit the lowest price points and lower price multiples than longer subsea routes. For submarine connections, you can see the core transoceanic routes such as London, New York, and Los Angeles, Tokyo in the middle of this figure offer more competitive pricing and multiples than, say, Miami, Sao Paulo, and LA, Sydney as you move further right in this figure. For Miami, Sao Paulo, and LA, Sydney, those markets still have a sizable demand for 10G service. 100G gained traction a little bit later, so those price points and multiples still remain a little bit higher. Overall, though, over the past few years, we've seen that 100G wavelengths continue to experience more rapid price erosion than the more mature 10G service. This figure is highlighting the change in 10 and 100G wavelength prices on LA Tokyo over the past 5 years. And as you can see, that 100G change, the turquoise line, has consistently tracked faster and outpaced that of the more mature 10G service in the dark blue line. Part of this trend is due to the fact that 10G prices on LA Tokyo are already extremely competitive without much more room to fall. And on top of that, as the sales volume of 100G wavelengths has increased, unit prices have fallen faster than the mature 10G product. And those cost savings are in turn passed along to customers in the form of lower wavelength prices. This higher rate of price erosion has also helped compress price multiples between the two services over the past few years. This figure highlights the 10-100G price multiple across key routes in 2016 in the dark blue column versus 2021 in the turquoise. And 2016 was really when we started to see 100G take off, be more widely reported in our pricing surveys, and we've certainly seen the multiples across all of these routes compress over time. In 2016, the average multiple was 6 times the price for 10 times the capacity across the routes featured here, and in 2021, it averaged about 4 times the price for 10 times the capacity. So certainly a difference over the years. And with 400G, while it may roll out at 4 times the price for 4 times the capacity, we expect that price multiple to compress as well, as we've seen with the 100G service. And price multiples don't just range across routes, but across carriers within an individual route. And these ranges are often a result of different carriers' price positioning and market strategy. For example, capacity multiples for 100G often skew low when a seller competes aggressively for 100G business and not for 10G. And we may see something similar happen with 400G service, some carriers focusing and placing emphasis on that, leading to a range in price multiples within an individual market. So how might 400G prices evolve? As with previous step changes in capacity, 400G upgrades are initially focused on shorter terrestrial links in Europe and the US, and will eventually move on to subsea links starting with the Atlantic. And these shorter, more competitive routes already boast the lowest prices on offer and the lowest price multiples, and we expect it to be the same with 400G service. While initially, price multiples may roll out at 4 times 100G price, savings will be achieved based on install and cross connects, and if history is any guide, those multiples will eventually compress, starting first on high capacity routes and then branching out to longer, lower volume subsea connections. And similarly to 100G service, that pricing strategy may depend on carrier type and emphasis, leading to a range of price multiples within an individual market. So we've covered a lot of ground today, but just to summarize and wrap up where we see these questions heading in 2022, while price erosion has certainly slowed, it has not stopped, particularly on routes with ample supply. For those routes with delays in supply and supply chain issues, price erosion is more moderate, but once those are resolved, we do expect to see an increase in price erosion. The focus going forward may not just be on new hubs. There is a lot of investment still going into Hong Kong, Singapore, and Japan, but also new landings and direct connectivity, a real emphasis on emerging markets and bringing content closer to end users. New direct routes, integrated backhaul, and technological improvements such as high fiber count cables will continue to offer cost improvements over existing options, and those lower costs will be passed along to customers in the form of lower prices. 100G has certainly become the most common transaction on most routes today, and lower unit costs for the service have driven lower wavelength prices globally. With 400G rolling out, we expect to see a similar price evolution going forward. Thank you so much for your time. Have a great day.